Hi, I
Hello,
think we're ready to start. Over to you,
yeah.
Yusuke. Thank you. Mhm.
Good morning, good afternoon, and good evening, colleagues. My name is Yusuke Taishi. I am the acting head of climate change adaptation in UNDP. I'm seeing a lot of people joining online, and I think we're starting the webinar. First of all, I would like to apologize to those who logged in and were waiting for this webinar last week. There were unexpected technical glitches and we had to postpone it. And I would like to thank those who are joining us today. How many people do we have online now? Um, Sorry, I don't see it on my screen. Oh, there are nearly 50 people. So thanks for those who were joining last week and who are joining us this week too. Today's webinar is titled Innovative Financing for Climate Adaptation: Unlocking Scalable Solutions. This webinar is the first of a series of webinars that UNDP plans to deliver in the coming several months. And the webinar series will focus on topics around moving from adaptation ambitions to actions. We all know that many countries are now setting national adaptation priorities in their NDCs and national adaptation plans, but there is still a huge adaptation financing gap. To help countries narrow this adaptation financing gap is the objective of the Adaptation Accelerator Hub, which is an initiative financed by the government of Italy under the 2024 G7 presidency. We will hear more about the AAH later, Adaptation Accelerator Hub, or AAH, later in the session today. This webinar series is also sponsored by the AAH. Today, we will be learning about innovative financing for climate adaptation, which is an important topic when we talk about narrowing the adaptation financing gap. Today's webinar is organized with NDC Partnership and the Center for Access to Climate Finance, hosted by the NDC Partnership. My colleague Esther from the NDCP's Center for Access to Climate Finance will be co-moderating the first half of the session. The second half of the session will be moderated by my UNDP colleague Prakash. Today, we will be hearing about three financial instruments, innovative financial instruments. As we hear from each speaker on the specific instruments, especially if you are representing a government, please ask yourself how these instruments can add up to systematically move NAPs and NDCs towards implementation, and what may be practical bottlenecks in your own country context. So let me turn it over to Esther to outline the webinar's objectives, set the scene, and take us through the first half of the presentations. Over to you, Esther.
Thank you so much, Yusuka, for the welcoming words and the framing. As Yusuka already mentioned, in this webinar, we are addressing the important topic of showcasing scalable solutions for innovative financing for climate adaptation. We will hear about the G7's Adaptation Accelerator Hub, which, as Yusuka also mentioned, was established by the government of Italy during its G7 presidency, and is doing to bridge the gap between planning and implementation. And we will also hear on G7 leadership on adaptation finance, the Adaptation Accelerator Hub's role in catalyzing innovative financing and global partnerships. You will also hear how the NDC Partnership and the Center for Access to Climate Finance support countries in unlocking adaptation finance by translating climate goals into investment-ready strategies through country engagement, tools, knowledge products, and convenings. Adaptation to climate change is now critical for survival, yet current finance falls drastically short, up to 14 times less than needed, leaving vulnerable nations like LDCs and SIDS exposed. To close this gap, participants at high-level solutions dialogue on climate change adaptation, which was held on the 22nd September 2025 in New York, called for faster, predictable, and grant-based funding, innovative financial tools, and country-led platforms that translate national plans into actionable investments. Countries need to and are moving from adaptation planning to action. There are resources and tools that offer ways forward for moving from planning to implementation in a systematic manner. We will hear about some of these resources and tools from the presenters soon. To guide you through today's agenda, we will begin with opening remarks delivered by Mr. Alessandro Negrin from the Ministry of Environment and Energy Security, Italy. Then we continue with two keynote presentations delivered by UNDP colleagues. From there, we will move into presentations on specific innovative instruments that are being applied on the ground, offering lessons for new sources of adaptation financing, namely bonds and resilience credits, risk finance and insurance, and special drawing rights-based bonds and trusts. We will hear from institutional experts and also country example on these topics. This will be followed by a Q&A from audience and a wrap-up by my colleague Joachim Leiter. Although there will be a dedicated Q&A session, we would like to encourage you to start to share your questions already during the presentations so they can be addressed then. As our first speaker, I now call on Mr. Alessandro Negrin, Senior Advisor, European and International Affairs Department in the Ministry of Environment and Energy Security, Italy, to deliver the opening remarks.
Thank you very much. Can you hear me?
Yes.
Perfect. Good morning, good afternoon, good evening, everyone. It is a real pleasure to join you today on this important webinar on innovative financing for climate adaptation. We know that adaptation is no longer just a protective response. It must become is becoming a driver of economic and social transformation and an investment opportunity. And this is a narrative that is also emerging in the context of COP30 that it will be open very soon in Milan. We all know that finance for adaptation remains a critical issue. It is clear that bridging this gap demands innovation across instruments, partnerships, and risk-sharing mechanisms, and a stronger alignment between public and private sectors. So the Adaptation Accelerator app that you mentioned that was launched last year with the support of UNDP was designed precisely to accelerate this transition, helping countries to move from planning to implementation and from fragmented efforts to coherent investment-ready strategies. The app's ambition is not to create new structure, but on the contrary, to align and strengthen what already exists: national systems, institutional capacities, and financial mechanisms. It obviously works with national governments, but also with development partners and financial institutions to turn national adaptation plans and NDCs into concrete pipelines and bankable projects. This obviously is done promoting coordination among the G7 members and partners worldwide. Through our first country engagements, including in Ethiopia and Cambodia, and also the emerging collaboration with Senegal, Mozambique, and Mauritius, we are helping or identifying opportunities to unlock finance, build institutional capacity, and connect national priorities with global financial instruments. And you'll be obviously hearing more during this important webinar. So in this sense, we see the AAH, the Adaptation Accelerator Hub, as both a catalyst and a connector. We intend to link national investment strategies with international funding sources, promoting dialogues between Ministry of Environment and Ministry of Finance, and foster cooperation with MDBs, philanthropists, and the private sector to design exactly the solutions that are most needed for those that are most vulnerable. And we think, and I think particularly that today's webinar is an important step in this direction. We'll be hearing, obviously, practical and scalable financial instruments. We'll be hearing important experiences, and obviously how enabling environments and policies and partnership are central to scaling success. And I think in this regard, while obviously there is an urgency of innovation, this does not apply only on financial products, but also in partnership and governance model, which are critical to develop instruments that facilitate accessibility to resources. So in conclusion, let me just say that we are particularly keen to offer the Adaptation Accelerator Hub as a collaborative platform that bridges policy and finance, and they connect countries and partners to turn concrete plannings in concrete actions. Before concluding, let me thank UNDP, the NDC Partnership, and the Center for Access to Climate Finance under the umbrella of the Adaptation Accelerator Hub for organizing this important exchange. And with that, I will stop here. I'm looking forward to hearing the promising discussion, and hand it over back to you, Esther. Thank you very much.
Thank you so much, Mr. Negrin, for sharing these insights, highlighting the importance of innovative instruments, enabling environments, and a collaborative partnership model. I would like now invite Mr. Rohini Kohli, Head of Climate Change Adaptation Policy and Planning at UNDP, and Ms. Cristina Gregorio, Climate Finance Specialist, Climate Finance Network in the UNDP Bangkok Regional Hub, to deliver the keynote presentation to frame the webinar. The floor is yours.
Yeah, thank you so much, Esther, and also Alessandro for that introduction. I'm going to speak briefly about UNDP's work on adaptation and how our work on the Accelerator Hub is very strongly nested in this broader programmatic work that we are doing. So there are sort of 10 thematic areas which are very, very linked to climate change adaptation, but also sustainable human development that UNDP is working on. So on top of the areas, there is the adaptation policy and planning work, which is about mainstreaming into planning and budgeting. And that's also the entry point for the public-private partnership, blended finance work, and the discussion about innovative finance instruments at the national level. There is a very significant field-based portfolio of locally led adaptation initiatives on livelihoods and food security, on a resilient infrastructure, on ecosystem-based adaptation, coastal adaptation, water resource management and access to water, climate change and health, and the emerging areas such as urban adaptation, urban climate resilience. So these are sort of the big programmatic areas, and these are the areas which actually require the investments in terms of more traditional sources, but also innovative sources and the blended finance sources. So this is sort of the entire portfolio of work that UNDP is doing under the Climate Promise. And just to also mention that the adaptation policy and work is nested not only to support national adaptation plans, but also the NDCs, because the majority of countries now have adaptation in their NDC, including the NDC 3.0. Next slide, please. So the coverage of the portfolio is we cover 101 countries, including the 43 least developed countries and 20 small island developing states. We've actually worked with a lot of LDCs even during the transition that they've made, out of the LDC status. There is, over the last 2 decades, you can see the numbers of people benefited, and also the grant funding, which is secured, but importantly, the co-finance that also comes in, when these public sources are leveraged for these solutions. Next slide, please. In terms of the sort of overall, some of the key numbers, so on the upstream level, we have supported 42 of the 62 national adaptation plans which are submitted. There is a number of more than 60 million people that have access to early warning systems and climate information. There are more than 1.1 million hectares reforested or restored, and there is 3.3 million people with enhanced access to water. And this is the kind of impacts we need to scale up. I mean, this is through UNDP's work, but there is a lot more that needs to be done in these areas. And it's sort of so a lot of this the work on financial instruments has to be nested in a lot of these interventions that we see on the ground. Next slide, please. And this is my last slide. We are very proud of associating with this G7 initiative or the Adaptation Accelerator Hub, which is basically looking at how the upstream work around the NAPs and NDCs, the priorities that have been defined, we know they are not very easy to finance, and there is a big financing gap. So how to really support investment readiness around this, looking at how to work with partnerships to connect with, global players such as the NDC partnership, the NAP Global Network. A lot of the G7 countries have investments in the country. How can we kind of, connect those and work across and try to provide a unique offering? It is to look at both the investment planning side as well as the bankable programs. We know that there's a huge demand for bankable pipeline development along with financial instruments. So we are working with 5 or 6 countries that Alessandro mentioned at the beginning to really demonstrate that this work can be done, to really accelerate the work that is already there, but we know that there's a lot more gaps. And we are working to provide comprehensive assistance in some cases, like in the case of Ethiopia, we would be working, looking at their NDC and NAP, working very with government leadership on identifying areas of high potential for investment, where there can be public-private partnerships and where there might be more avenue for, blended finance opportunities. And we also have another kind of suite of services which are more limited in nature, more targeted, I would say, where we really support what an existing, G7 country may be doing with a developing country partner, where we can really bring that kind of, specific need, around perhaps convening an investors roundtable or crowding in more finance, doing investor mapping, something to really push the needle and elevate and connect the work that is already happening and make a sort of a wider, stronger adaptation investment coordination possible, and to bring more financiers in. We would be supporting adaptation financing strategies, and you will hear a little bit about the guideline that we would be using, that Christina, my colleague, will be discussing. We have fashioned a technical assistance offer, which is limited. The guideline is much wider, and that guideline can be used across the world. But our main work will be to really see how to pilot blended finance instruments and leverage public-private partnerships, through other partners such as the Insurance Risk Finance Facility, and making sure that we have a very clear offer on private sector engagement. A lot has been discussed about it, but the AAH has developed a private sector engagement strategy, which is really nested with also the work our partners are doing. So it is not to do the work alone, and to really link up also to the Rome Process Financing Facility. So I think with that, I'm going to turn to my colleague Christina about to show us the adaptation financing guideline, what the components are, which would be available to all countries, and UNDP would be applying it around the world. Over to you, Christina.
Thank you very much, Rohini. And just wanted to check if you're able to see my screen. Just starting this slide. So good afternoon, good morning, and good evening to everyone. Just starting this introduction on the Adaptation Finance Strategy Guideline with a recently launched report on adaptation finance gaps by UNEP last night. And I opted to include this slide simply because, the headline is running on empty. The world is gearing up for climate resilience, but without the money to get there. So having said that, UNDP also has supported the formulation of NAPs and NDCs across the world. We'd like to also offer, together with the AAH, a tool that is useful for countries. And as Rohini mentioned, this could be applicable globally to countries, particular sectors, particular ministries, even some private sector partners who would like to contribute in bridging the gap between policy and investment in terms of adaptation. So I think one thing to highlight in this particular report is that climate resilience must become an integral part of the financial decision making. So more than informing policy design and planning investments per se, the role of financial markets, enabling environments, choosing the right financing instruments to be able to support implementation of identified solutions would be very critical. And as Alessandro mentioned in the opening, adaptation finance is very much crucial, especially for developing countries, especially how adaptation affects lives, livelihoods, and economies. So all of these are triple dividend if we invest in climate. So just moving on from the more focused on the adaptation finance strategy guidelines. So this guideline has been supported by the Climate Finance Network and UNDP's Global Adaptation Team together with the Sustainable Finance Hub. And we hope to make the complete guide available publicly around COP30, which is happening in a few weeks. And we'd like to highlight that this guideline is intended to be a practical, country-driven framework to translate adaptation priorities that could be from the NAPs, the NDCs, or other climate plans into investable strategies and financial flows. So we prepared this guideline particularly to support ministries and agencies to formulate a viable and inclusive adaptation financing strategy. So we don't intend to duplicate the other guides and frameworks of partners, but instead complement the investment plans and frameworks prepared, for example, by OECD, the ADB, NDCP, and IISD, among others, as part of a government's mandate to develop and implement their NAPs and NDCs. So why did we initiate this aside from the obvious gap and the interest of UNDP to contribute and facilitate the shift from planning to implementation? It's also because, as mentioned in the beginning, is to really differentiate the aspects of adaptation acceleration, including the difference between a strategy and an investment planning process. And also note that accelerating investment in adaptation that need not be the whole economy or, for example, all the sectors indicated in a NAP or an NDC, but it could be specific sectors. It could be at the national level. It could also be at the subnational level. So just in terms of an overview, the guide that we have prepared is created for flexibility, also based on existing data that could be applied at the national or sectoral level, and um, based also on the fact that we're relying on existing data. It also acknowledges the different capacities and contexts of countries that are trying to undertake adaptation investment. So just to dive deeper into the financing strategy, it has four phases. So it comes in different modules where first one essentially is prioritization or identifying the data situation, elements in place, what is in place, what is missing in terms of the NAPs, in terms of priorities, who are the stakeholders that are part of the could be part of the financing strategy development. Ideally, because of the NAP formulation process, the financing strategy would also rely on the same stakeholders that are involved in the same policy process. Because this financing strategy focuses both on the supply and the demand of climate finance. Phase two focuses on the demand side of finance, meaning the implementing entities by sector. This is where the capacities, institutional mandates would come into place and where identification of various constraints and sector priorities would help identify particular business models. So, for example, this is where we would hope that the countries or the users would be able to identify if they would choose traditional financing, innovative financing, which instrument, or for example, blended finance. And on phase three, this is where the supply of finance comes in, where the financing sources or the enabling environments come into place. Um, this is where the domestic capital markets come into uh, priority, for example, because we are trying to blend resources both from national budgets to domestic resource mobilization, complementing the scarce ODA at the moment, but at the same time tapping private sector finance through domestic capital markets. So this is where we're hoping that through the framework that we have designed, we'll able to identify financing sources. And on phase four, this is where everything comes together in terms of mapping the resources of finance applicable or could be tapped for both the identified priority areas of a particular country, identifying the gaps in terms of enabling environments, governance arrangements, policies, or institutions. This is also where we're bringing in the inputs from phase one in terms of the dialogue with financing partners. And I think a crucial part of this is also the monitoring, reporting, and verification, which aligns with UNFCCC and Paris Agreement work on enhanced transparency framework so that we are able to monitor the performance of the financing that we've actually all tried so hard to be able to deliver to implement adaptation strategies. And because a key component or key contribution of UNDP's financing strategy guideline is revenue streams and business models, I just also like to highlight we've adopted the multilateral development bank categorization of projects into based on type 1, type 2, and type 3 projects, where investments could either be just for climate proofing projects, could be particularly focused on adaptation by sector, and of course, those that are contributing to reducing the underlying causes of vulnerability. So this could be social protection, probably health, etc., education, that could remove barriers to adaptation. But when we're talking about adaptation investment, it is very important for us to look at the revenue streams. Are these coming from the budget? Is this coming from ODA? So among the three types of investment types of in terms of adaptation, there are those that have clear revenue streams, but there are those that do not have a clear revenue stream by design, but could have some revenue streams in the future. And there are those like for type 3, for example, that we really have no prospects of having a dedicated revenue stream. And so this is where the grants and TAs would still be very much instrumental to facilitate implementation. This is not a definitive or like a final list of business models and financing mechanisms, but maybe just to outline, for example, the difference and effects of a type 1, type 2, type 3 kind of investment, where for a climate proofing cost related kind of investment, the benefits are often very direct and localized because it's very specific. And of course, just to have examples of instruments that could be used for climate proofing, this could be include user fees, tariffs, and private contracts. But in terms of financing, of course, because of user fees and tariffs, it could also come together with some commercial finance and offtake components. For those projects or investments that have partial cost recovery, this is where the blended finance type of instruments could come in there in terms of PPP, for example, where financing modality could be land value capture more on the related to transport and land use. You can have local levies, blended tariffs, or the PES systems, for example, more on nature conservation. So just to show in this particular table that, for example, if you have type 3 type of adaptation investment, there are in cases where it will just become an absolute public good. And so we need government and other, benevolent partners such as philanthropists to be able to contribute to investments that have no public or no economic or financial return. This particular slide, I'm not going to go into every detail, but just to show that business models also have various archetypes, and that sometimes, for example, for a full cost recovery commercial PPP, the initial example of investments could be urban utilities or industrial services. And here you see on the third column the different types of revenue sources. So you will see all of these in our adaptation finance strategy guideline. It's peppered with various examples across the UAE, UNFCCC sectors for adaptation. And we also have descriptions, not just aside from business cases and business model examples, but also the proponents and what kind of enabling environment would facilitate investments across these particular sectors and across these particular instruments. So maybe just going towards the last few slides, just going to show also the impact of the cost of the type 1, type 2, type 3 kind of investments that over time, of course, if we are investing on the basic kind of investment, the cost is naturally lower. But over time, if we focus more on, let's say, adaptation focused types 2 and 3 investments, then the cost could be higher. So these kind of impact on the costing of the investment would definitely affect the type and structure of the implementing entities, and at the same time, the kind of revenue streams that we would choose in terms of designing or choosing which instrument to be able to use to be able to implement the adaptation priorities. So just to just probably as a summary, you have here the QR code. Here is the QR code to the executive summary of the financing strategy guideline. We will share, of course, with the team, and thanks to the adaptation team of UNDP, we'll share the final complete guideline in the next few weeks. And just to see here on the left side is a summary of the 4 phases of the guideline, which countries could undertake. It's not sequentially, so it depends at which depends on their readiness, depends on their priorities as well. And some countries with data would probably proceed with phase 2 right away. then some who already know phase 2 and phase 3 would immediately proceed with the development of a strategy. With that, I'll end there. Thank you very much, and over to you, Esther.
Yeah, thank you so much, Rohini and Christina. It was very insightful, very inspiring, sharing the country examples, the insights on the adaptation finance strategy guidelines. Speaking about business models actually links already very well to the next segment of this webinar today, as now we turn to presentations. To financing instruments. And the first type of instrument we will explore today, it will be bonds. And we will hear about the experience of Uruguay. I would like now invite Mr. Juan Labat to share his experience with the sovereign sustainability-linked bonds.
Good morning to you all, or good afternoon to you all. Thank you, Esther. I think you are seeing my presentation and you are hearing me correctly. First of all, let me thank the organizers for inviting me and for the interest in Uruguay's experience. For me, it's an honor to share our experience, and especially it's very interesting to hear about what other countries and organizations are doing in this area, because it's innovating in finance in order to include sustainability objectives and to move forward climate action. For us, it's something that we are working on. To start with my presentation or with my remarks, I want to emphasize something that we think that it's very important here in the Ministry of Finance of Uruguay, and me, that I have the opportunity to coordinate an environmental unit in this ministry, is that when we think about in finance innovations, in particularly climate finance innovation or adaptation climate finance innovations, we think it's crucial to remember that what is important is to that innovations to allow us for more climate action. It's not to innovate or to make innovations in the finance area itself, but it's important that these innovations track or move forward more climate actions. I'm saying this because we believe it's important, and because we believe that what we have done in Uruguay with our debt management strategy, incorporating climate objectives and biodiversity objectives, help us to move forward environmental action. I will return to this in a couple of minutes, but previously I want to share with you what we have done. Perhaps you already know, but Uruguay in 2022 issued a sustainability-linked bond, a sovereign sustainability-linked bond that had a global innovation that was to include a step down, a reward, if we achieved certain climate and nature objectives. In 2022, previous to 2022, when we were working the design of this instrument, what we saw, and this is what I want to share in this slide, that the markets were, the demand and the offer of this kind of instruments were increasing exponentially. So there we saw an opportunity. We believe, and connecting with what we are talking today, we believe that this interest of the markets for thematic bonds in 2021 that we saw, nowadays it's moving and it's incorporating adaptation bonds and instruments. We have recently talked with certain market agents, and they confirm this idea that adaptation nowadays is something that asset managers are looking to. So we think that's something interesting for this conversation. And something else that was very important for our experience and for issuing this bond in 2022 is that we had already sent to the UNFCCC our first NDC. In 2017, Uruguay presented to the UNFCCC our first NDC, which had targets to 2025. That instrument, that climate instrument, was crucial for designing our sustainability-linked bond. And we took, the Ministry of Finance, took from our first NDC 2 KPIs that were already defined in our first NDC. One was the reduction of GHG, greenhouse gas emissions, in relations to GDP. We had an objective to reduce that intensity from 1990 to 2025. And also we have an objective to maintain native forest area to 2025. So no deforestation objective in 2025. Remember that we present our first NDC in 2017 that had 2025 objectives to 2025. We designed this bond during 2020, 2021, and in 2022 we issued this bond that depended a lot in our NDC. What we did with this bond is to define 2 kind of targets. One that was like, let's say, a first target that was the one that we put in our first NDC, that it was to reduce in 50% the intensity of emissions per GDP unit, and to maintain 100% of our native forest area in 2025. But also we put a more ambitious target that was to reduce even more that relation of that decarbonization track, in order to reduce it more than 52%, and also a more ambitious target in the native forest area, to increase that area more than 103%. So we defined 2 targets. One that we needed to achieve, that it was already compromising our NDC. Let's say that we have like a buffer zone, and then a more ambitious target. With those 2 types of targets, we defined, and of course the market accepted and helped us. We achieved this idea that it's what we believe it was a global innovation. When we issued this bond in the market, in the sustainability-linked market, we only saw a punishment, the possibility, if you didn't achieve the objective that you defined, you had a penalty. You have a step up in the interest rate. With this idea, with these 2 types of objectives, one that was already defined in our first NDC, but another one that was more ambitious, what we put in the market is the idea that we can also have a reward, a step down in the interest rate. And I think it's very important. I want to focus on this. I think that this innovation, that was a global innovation in 2022, we didn't see any sovereign bond that had this possibility of a reward, of a step down in the interest rate if the country achieved its climate commitments. We think it's very important, and it's something that we have to move forward to the adaptations finance necessities, and we think it's an innovation that could work in the adaptation area. So what I am saying is, like, we put in the market a bond that if we achieve, as I said, 50% of the reduction of GHG emissions per GDP unit, 50%, if we don't achieve that objective, the interest rate of the bond will increase. If that KPI in 2025 it's between 50% and 52% a reduction, the interest rate won't change. But if we achieve a more ambitious target and our GHG emissions per GDP unit reduces more than 52%, we will have a step down in the interest rate, in the coupon of this bond. That is the global innovation. And the same we define it with our second KPI, with the one that relates to native forest area. This idea, this innovation of a reward to countries or perhaps to companies, that it's the same, that goes beyond their commitments and have a more ambitious target, this possibility of reward, we also implement it in the loan market, sovereign loan market. After issuing the bond, 1 year or 2 years after that, with the World Bank, we designed a loan that had a similar structure. It had the possibility of a reward, of a step down, if we achieve also commitments and KPIs that we already put in our first NDC. But here with the World Bank, we also incorporate a KPI and objectives that we put in our second NDC with objectives to 2030. And also we put the possibility of having a reward. What I think it's interesting, especially for countries, for sovereign debt, is that we achieve with the World Bank only to have a reward. In this instrument, we didn't include, as we did in the bond, the possibility of a penalty, of a step up in the coupon. Here we only have the possibility of a reward. So what I want to share is that this innovation that we apply in the bond, we improve it, and in the loan market we had the possibility to improve it and only put the possibility of a reward. And now, just to wrap up, I want to share three things in order for you to have in mind that we believe that is important. For this financial innovations to work, it's important to think what the market, what the asset managers want, which is the demand. When we were designing the bond, we talked with a lot of asset managers, that are the people who decide and buy and bought this bond or this kind of bonds. And for them, it was very difficult to convince them to buy a bond which could have a step down, because that would imply that their investors were, let's say, investing in something that, if the country achieve its climate commitments, they will receive a lower interest rate. But we convinced them, and we are convinced that that's not the way to see this kind of instruments. This kind of instruments, if the country or the company, because you can also think about corporate bonds with these characteristics, if the country or the company, the issuer, achieve its climate, biodiversity, adaptation, or environmental commitments, this step down won't reduce the yield of the instrument. In fact, it will increase it, because the asset will increase its value. And that's something very important, because here we can't forget the interest of and what the asset managers in this case are looking for. This idea that if we reduce the coupon, we reduce the interest rate, this is a reward for the issuer, it doesn't imply to reduce the yield of the instrument, because the value of the asset will increase. That idea, we are testing it nowadays. That idea is crucial for the demand for this kind of instruments. Second, and perhaps more important, and returning to the idea that we innovate in order to deliver more climate adaptation, biodiversity action. It's the idea that this innovation, this reward, could generate a virtuous circle. And why I'm saying this? In order to have more climate action, we need, especially developing countries, we need to free resources. We have a limited budget, especially when we are talking about the public budget. We have a restriction there with our public budget. We have to construct schools. We have to invest in public security. So investing in climate action, we have to free resources. If we want climate action, we want to free resources. This kind of innovation allows to free resources because you are paying less interest rate. But in order to free resources and to free an important amount of resources as a premium, as a step down in the interest rate, you need an important reduce in the coupon. But to have an important reduce in the coupon, the markets, the asset manager, or the multilateral development banks, to give countries or companies an important reduce, an important premium in the interest rate, you have to show more ambitious. If your ambitious is quite poor, markets and the MDBs won't give you an important step down. And if you have this climate ambitious, you could deliver, you could free resources, and you could have more climate action. There we are seeing like a virtuous circle that this kind of innovation brings to corporates or to sovereigns, that we believe it's very important. And to wrap up, to finish with my presentation, I want to share that here in Uruguay we are working, the Ministry of Finance, but also with the Ministry of Environment. We are analyzing the possibility of taking this idea, this innovation, this step down innovation, this step down in the interest rate or in the coupon innovation, to new instruments that incorporate adaptation KPIs. We are starting that path. We are starting to work in that idea. We believe that we are analyzing the possibility of designing this kind of instrument, loans, sovereign loans or sovereign bond, that incorporate adaptation KPIs and include the possibility of a reward if achieving these adaptation KPIs. We are just starting with that idea, so it's something quite green, but we are trying to move these innovations to the adaptations finance area. That's it for me. I'm here for any question, and over to you, Esther. Thank you very much.
Yeah, thank you so much, Juan. I'm sure there will be a lot of questions, but please keep it to the Q&A or type it already in the chat. It was really very interesting to hear your experience, sharing key recommendations, conditions that have to be in place. It was also interesting to hear the strong connection between the bonds and Uruguay's NDC. Very good example of how to turn plans to action. We will now continue with the second instrument we will cover in this webinar, insurance and risk financing. But before doing so, let me also turn the moderation to my colleague from UNDP, Mr. Prakash Bisla.
Thank you very much, Esther. Okay, can you hear me? My screen just went dark. Okay, excellent. So we now are moving into the second part of the session, where we're looking at how countries are managing the very real climate risks that we're already seeing today, and how financial tools like insurance and disaster risk financing can help governments, but also businesses and households bounce back faster and more fairly. So to guide us through this segment, we'll hear from two colleagues who work directly on these solutions. Ms. Tuga Alaskari, who's a technical specialist with UNDP's Insurance and Risk Finance Facility, and Mr. Zonke Kret, who is the Executive Director of Munich Climate Insurance Initiative. So I know Tuga has other commitments as well at the top of the other hour, so I'll pass it right on to you, Tuga. Go ahead.
Thank you so much. I hope you could see my slides. I'll share with you a bit of the work that UNDP does, but what I've been asked to do is really focus on how this is playing out in country. I've really appreciated the presentation so far. They're very concrete. Some of the slides I have are a bit higher level, just to set the scene. In 2024, global economic losses from natural catastrophes amounted to $318 billion. But actually, that's quite an abstract number. Today, we've woken up to see the devastation that Hurricane Melissa has wrought in the Caribbean. A stark reminder of the reality of what's at stake, what we're speaking about. Now, the effects of disasters are felt 10 times harder than in richer countries in LDCs. And actually, in the context of emerging markets and LDCs, a lot of those risks are shouldered by public budgets, vulnerable populations, and the public purse. Essentially, they are not insured. The insurance penetration rate in many of these countries is very low. And that makes quite a difference. In the hurricane I just referenced in Jamaica, the government actually has quite a comprehensive setup there. They've got a catastrophe bond, they have sovereign risk finance in place, they have a disaster risk finance strategy that's mapped out the different layers of need for different scenarios of disasters. And it's anticipated that they would receive approximately 800 million. The Minister of Finance today said 800 million can be drawn on in the coming days and weeks. They have contingent credit lines mobilized. It's not going to solve for the whole problem, but that is an important lifeline to address the most urgent needs. So this is why we are concerned by this topic. We understand insurance and risk finance as part of a broader strategy to protect lives, livelihoods, and development gains in the face of escalating climate impacts. At UNDP, we work across a number of levels. So I mentioned the work on sovereign risk financing. We work with governments to see how they could ensure that they are in a position to manage risks and have the financing in order to address the relief, recovery, and reconstruction needs. We also work on households, businesses, and farmers to have direct insurance products for them so that they could then also finance the impact of those losses. We work across ecosystems, so we have some work related to nature, looking at how we could build resilience of ecosystems and the communities that depend on them. For example, we have an initiative in Indonesia, which is looking at heating the ocean surface temperature, and a payout is made once it reaches a certain threshold, meaning that communities can immediately implement restorative action to stop that coral reef from being damaged. And then, of course, de-risking investments and food systems and supply chains. And then finally, looking at accelerating investment. So insurance is seen as a tool as part of broader sustainable development agenda. We have a geographical footprint across 39 countries where we implement insurance and risk finance activities. But this is the slide I want to focus on. So the way we work in UNDP is, on the one hand, we work on solution development. These can be sovereign, meso, and micro. One example I can give is very recently, we're at the final stages of an urban flood insurance scheme for Lagos State. Flooding is a major concern for the government there, affecting communities, debilitating critical infrastructure like hospitals in the aftermath of disaster. This scheme would allow the government of the Lagos State, within 2 weeks to receive an injection of financing that would allow them to restore the functioning of their city and to ensure to safeguard the livelihoods of those affected. We also work on policy, regulation, and law. This actually was a very critical pillar of this work. For example, in the work we did in Uzbekistan, we have an agricultural insurance program there. It was enabled by a legislative change that made the pricing structure more appealing, more for both the local insurance companies, but also for the farmers that are benefiting. We also have regulation work, for example, in Ecuador. Just today, we launched a parametric insurance product that would protect farmers. It was not possible to have a parametric insurance product in Ecuador. There was no regulation for that. UNDP worked with the government to create that regulation. We also work on the delivery systems and channels because the payout is not enough. How do you ensure that that payout is in fact delivered to the most affected populations? What are the social protection systems that would be used? Are they up to date? What is the targeting? What is the infrastructure? And then when we talk about microinsurance, how do you ensure that there's digital and financial infrastructure? But all this to say that these are exciting projects, but on their own, they do not have the potential to be sustainable. One of the things we've observed in the last 2-3 years that we've been working on these projects, we've had 20 government changes across 20 countries. So to ensure the sustainability of this work, it needs to be anchored into development plans, into climate policy. It also needs to make sense. Insurance is not a goal in itself. So when we're looking at the pricing signals that are emerging from these products, we need to understand what does that mean in terms of adaptation needs? What does that mean in terms of disaster risk reduction? In the context of rising risks, some of the products we're dealing with are facing a risk of uninsurability. You cannot insure something when the cost becomes too high. So as part of this work, we worked with our climate team at UNDP and with the Munich Climate Insurance Initiative to come up with 2 critical documents. One of them is an analytical report that looked at how to integrate climate and disaster risk finance and insurance into climate policy, and then a supplementary guideline that we use to guide our work on how to structure the integration of disaster risk financing, international adaptation planning. And this piece was taken up by UNFCCC as one of their supplementary guidance for member states. So I'll stop here and I'll hand over to the lead author of these 2 papers. I will unfortunately need to drop off in a few minutes. So for smoothness sake, I will stop sharing and Sunka will share his screen, if that's okay.
Thank you very much. And Sanke will be around also for any questions that you may have, and we'll be able to respond to them. And as my colleague Esther before me also mentioned, if you have any questions, please do feel free to already start putting them down in the chat box. And we will also have a session for it at the end of the session. But over to you, Sanke, without any delays.
Yeah. Just a quick moment. Am I sharing the right document? Yeah, okay. Sorry for that. We planned it slightly different, but we have to account for the slight delay in the program. So I'm going to talk about the 2 documents that Tuga kindly introduced. So I'm Sönke Kraft. I lead the Munich Climate Insurance Initiative. We are a mission-driven organization working across governance, risk analytics, and also the solution space, working on disaster risk finance and climate insurance. And in terms of these documents, I want to start a little bit like what is in it? Why are we actually wanting to marry the climate disaster risk finance discussions and processes with national adaptation planning or the nationally determined contributions? And one is clearly that these instruments help on the financing side, so to allow for liquidity and also stability post-disaster, and also have like a quick and reliable way to channel support after climatic events. We're also looking at de-risking functions, so de-risk investment that are necessary for climate resilient development. And then we're also talking about the financing strategy itself. And I mean, Tuga, you mentioned it already on the example of Jamaica. In order to effectively deploy some of these instruments, they need to be embedded in a comprehensive strategy. We're often talking about risk layering. The end result of that strategy is that we are actually managing different adaptation options in a more cost-effective manner. Then another win by bringing these two discussions together, climate policy on one side and climate and disaster risk finance and insurance, is that we also need to have a good risk understanding in order to structure some of the instruments. So there are also co-benefits in engaging and improving the data situation and technical capacities in the countries. Then the next item would be to structure the instruments. You have to work together with the stakeholders. You need to know what kind of risks are lying on the country budgets, who's owning that risk. This, at the end of the day, will also foster intergovernmental and public-private collaborations. And lastly, we hope that through, for example, insurance instruments, microinsurance instruments, we have like concrete instruments that can help vulnerable communities and sectors and be of concrete help after a climate disaster. The policy note analyzed the status of all national adaptation plans, as well as the NDCs, to see how countries are managing the interplay so far. And what we've seen is that the majority of countries in their NAPs introduce insurance aspects. We also see that this is the case for the NDCs, where a sizable 69 out of 169 countries have integrated climate and disaster risk finance components. And we can also prove that higher level of insurance readiness, there's an insurance readiness score in the literature, is correlated with a greater degree of integration of disaster risk finance elements in the national adaptation plans or the NDCs. And I think this shows the benefit to work on the enabling environment and to aim to advance policy integration. In terms of concrete example, one thing I can highlight is Colombia. And you can see that Colombia, across its climate policy tools, meaning the National Adaptation Plan, but also the NDC, have highlighted agriculture insurance or expansion of risk transfer solutions, and they've also implemented this in the real world. So that's one good example where policy integration can lead to concrete action and can also signal support needs for climate financing institutions. As I said, we develop not only the policy note, but also the guidelines. So these are meant to be a step-by-step process, how to better integrate climate and disaster risk finance into the national adaptation planning process. It works with the existing guidelines of the national adaptation plans. And here you can see the general structure and why to engage in such a process. And in terms of the concrete way, I'm not going through all the steps, but basically we developed a menu of different steps that can be used in the modules that prepare for the National Adaptation Plan. And we also focus on what can be done when there is already a National Adaptation Plan, how to better disaster risk finance and insurance. These are the two documents. You can snap also to the QR code. And of course, I'm ready to take any questions in the question and answer session. Over.
Thank you very much, Sanke, for that overview. And also to Tuga, who's left us now, but for these insightful presentations. You've helped us to think not just about the instruments themselves, but also the enabling conditions that the countries would need to put in place for insurance and risk finance to really drive resilience. Now we'll turn to another mechanism that is increasingly shaping discussions on climate responsive investment, and that is the IMF's Resilience and Sustainability Facility, which makes use of the special drawing rights. And I'm very pleased to invite at this point Ms. Stella Tesiriayo. I hope I'm not mispronouncing your name, who is the chief economist at the Ministry. Well, thank you. Thank you, Stella. Stella is the chief economist at the Ministry of Finance and Economic Planning in Rwanda, to share about the experience in accessing and operationalizing this facility. Stella, the floor is yours.
Thank you very much, and really thank you for having me for this discussion. I would like to share three things that we were able to see as we were implementing the Resilience and Sustainability Trust fund as one of our program with the IMF. But before I do so, I also wanted to probably give some context as to why we thought the instrument was important for us, and given the situation we had. So we subscribed to the RSF in 2022. And at that time, if you recall, we were coming out of COVID, and there was also a number of different crises that we were being exposed to, like many other countries in the world. So which means that in terms of our fiscal space and our ability to respond to different shocks, it was being reduced. And more specifically, as Rwanda, we are also exposed to different climate shock, like the droughts, the floods, but also landslides. So on top of the risk that was caused by COVID and the fact that we had to use our fiscal space, we also needed to see how we could address the issue of climate adaptation and mitigation. That's how the RSF came up as one of the instruments that made sense for us. Why? Because, and that's one of the things that I wanted to share. The first thing is because the RSF, in addition to availing financing for the budget that could be used, it was also supporting the balance of payment. So on one hand, it was supporting in terms of tackling issues related to the climate shocks, but also helping to support macroeconomic stability while supporting the balance of payments. Another thing is the fact that the RSF is concessional. So we were able to access the funds to an interest rate not more than 2.25%, maturity of 20 years, and a grace period of 10 years. So that was also consistent with our medium-term debt strategy, which was to look at affordable ways of tackling our issue. The second thing that we saw as we were implementing the RSF was the technical assistance that comes with it. So we were able to introduce a number of reforms. To be precise, we introduced 11 reforms throughout the PFM cycle, from the selection of a project to the allocation of the budget to the monitoring of how a project is being implemented, using the technical support from the IMF. But we also were able to, apart from the PFM cycle, to also improve the way we assess fiscal risks, especially risk related to climate shocks. Since 2020, we normally draft a fiscal risk statement that is being presented to the parliament along the budget, the national budget. And we were able to add a specific section that looks at risk that our state-owned enterprises are exposed to. So that is in terms of macroeconomic assessment, but also looking at to what extent do we lose in terms of GDP, but also to what extent do we add in terms of pressure to our national debt if we don't take an action for climate. So all those reforms, we were able to do that through the RSF program. In addition to that, we came up with a green taxonomy during that period as well, that we did not have. But also for the financial sector, through our central bank, it was communicated to the commercial banks into Rwanda that as they provide financing for the private sector, they also need to look at issues related to climate shock. So there is an element of financing for the budget, for the balance of payments, affordability of the financing, an element also of technical assistance into embedding into our processes, both PFM cycle, but also macroeconomic assessment, how to look at issues related to climate. But the last thing that I wanted to mention to you, which is more on the innovative side of the RSF, is the fact that the RSF had a catalytic effect. So we have a development bank, which is the Development Bank of Rwanda, where a climate fund was created, and it was launched by His Excellency the President of Rwanda during the COP27 in Egypt. He launched the fund and with an amount of 100 million at that time. But part of the money that we received from the RSF, we were able to take about 40 million of the amount on lend to give to our development bank, and that amount has helped to de-risk and attract more money into the fund. So today, the fund was able to attract, initially it had 100, it was able to attract additional 200 million. That is for the Development Bank of Rwanda. But for the National Treasury, on top of what we received from the IMF, we were also able to crowd in additional money from other development partners, about 100 million. So the RSF money that we received, about 300 million and 19 in the beginning, we ended up with additional 300 million, of which 200 million for our development bank and 100 million for the government. So that catalytic effect is one of the things that is innovative about the fund, the RSF itself. So, but there are three things that we needed to as prerequisite for the RSF to be implemented smoothly. The first thing is the political will, political commitment. So it's clear from our vision as a country that we want to have a green economy. When you look at the different strategies, the different visions that we have, it includes a climate action agenda, which is very clear for us. The second thing is the fact that for us to be able to implement the different reforms, I talked about 11 reforms that we were supposed to implement over a period of 2 years. Actually, we implemented them in advance with 6 months ahead of schedule. We were supposed to implement them over a period of 3 years, which is the time of the program, but we were able to implement them during 2.5 years with 6 months ahead of schedule. So that is the reason why it was possible. It's because you have technical capacity. You need to have institutions which are ready to absorb the amount of reforms and actually implement them. The third thing was to maintain macroeconomic stability. And that is not straightforward because when you access to an instrument like the RSF, one of the things that you need to do as a country is maintain macroeconomic stability. It was not easy because we were going through a number of different shocks, from COVID to the Ukraine-Russia, after that to different disease like the outbreak of Marburg, etc. So all of that put a lot of pressure on the macroeconomy. But despite that, maintaining stable macroeconomic environment, adequate level of reserve, implementing also a fiscal consolidation plan, which helped us to continue to access those affordable sources of financing. So this is what I wanted to share, given our experience as Rwanda. Thank you very much for the floor.
Thank you very much, Stella, for those very thoughtful reflections, and also for grounding the discussion in the realities of the national policy decision making as well. And you presented a very interesting aspect as well on the dual purpose of RSF, on it both tackling the climate shocks, but also supporting the macroeconomic stability. And the innovation with the establishment of climate fund. So thank you very much for those insights. And now we turn to the question and answer section of our webinar. And I have a couple of questions already in line, waiting for some of our presenters. So I'm going to request first my colleague Bertrand Reissé to pose his first question to one of the panelists, followed by Mr. Lawrence Schaefer for the next one. Bertrand, please.
Thank you very much, Prakash, and thank you to the different panelists. It was a very interesting presentation. Basically, a specific question on Juan's presentation. This sustainable linked bonds basically are raising two questions on my side, quite practical. The first one is the framework you have showed. I'm interested in knowing, is it more expensive to, I guess so, to design such sustainable linked bonds? And is it significantly more expensive that, let's say, business as usual bond Uruguay is already is issuing in general? Just to have another view of, is it significant or not? I don't know if you can share this information with us. And basically the other question is, you've been discussing of people interesting and the institution interested in taking such bonds, with the limitation of having the, let's say, the new habit of accepting to have lower interest rate in case you are very much successful. So my question on that is, this type of actors are only MDBs so far, it's what I've understood, or do you have also discussion with, let's say, more private institutional investors? Because of course MDBs or bilateral development banks can be key players on that, but at some point I think it's interesting to envisage how this can be also expanded to the, let's say, business as usual market of such bonds, and whether or not there is at the moment an appetite for such interesting products. Thank you, Juan.
Thank you for the questions. I hope you can hear me okay. I'm going to the office, so I'm not sharing my screen. Thank you for the questions. They are quite easy. The first one, I won't say that issuing this kind of bond it's more expensive in let's say in resources. It's more expensive because it's something new. In the experience of Uruguay, it implies a new way of working with the Ministry of Finance, the Ministry of Environment, our Ministry of Livestock, our Ministry of Energy. That whole of government approach imply more efforts, which I can say that yes, it's more, let's say, expensive, time expensive, but also it implied that the Ministry of Finance start working and understanding a lot more climate action in the livestock sector, in the energy sector, with the Ministry of Environment. So it also, the design of this instrument also, it took a lot of time, a lot of effort and coordination, but that we think that is also something that we gain, and we think that's a very important improvement and a positive externality that this kind of instruments give us. That's I think that I try to answer the first question. The second question, and I understand that what you are asking, if we have checked with let's say, private investors about the possibility of an instrument that only have the reward, the step down. We haven't checked it. The instruments, bonds or loans that only have the reward or only have the step down possibility, we have proved it with the World Bank that, as you said, you can think that it's easier because it's a multilateral development bank. We haven't tested with the market, but we think that we have to move in that direction. And as I said, we have to help investors to understand that a reward doesn't imply less return, less yield to their investors. We have to convince asset managers that a reward doesn't imply a lower yield or a lower return to their investor, because the asset will increase its value and probably it will increase its yield. But the concrete answer is that no, we haven't tested in the private sector. That I think that was your question. Thank you.
Thank you very much, Juan. Next, I turn to Lawrence Schaefer. Please, if you'd like to state your question.
Hello, everyone. Lately the global flagship for food security has been created. There's a lot of attention around food security. During that global flagship for food security initiative, they were talking about a science committee so they could do a proper formulation of doing an evaluation of a project or a program on agriculture for food security, because there is more value that goes into a program that is not even measured. If we're talking jobs, if we're talking mortality rates, if we're talking, a lot of different factors. And so they are expanding their net, as it were, to better define the full impact of programs, because everything has to have an ROI. We're no longer in this whole world of grants and humanitarianism and all of that, even though I've been told that there are some things that are changing in that world as well. But for investors, when we're talking about these things, it has to have an ROI. Now, can you give carbon credits to countries like Gabon or Cameroon that have massive forests like Guyana did? Can you give carbon credits to farmers that are doing restorative practices? Yes. Well, how do you evaluate them? You look at a country like Australia and they've nationalized those programs. So can we really bring into the metrics evaluation on the impact of agriculture programs beyond just sale of a product, how much return you're getting from the sale of a product, and what your profit margin is? If that helps.
Thank you for those reflections, Lawrence. Yeah, if any of our speakers would like to respond to that, it's a good point that you raised. But if any of our speakers would like to respond to that, the floor is open. Okay. Well, thank you once again to all of the speakers for all the thoughtful presentations and reflections that you provided today, and thank you also to everyone in the audience for the engagement, the questions and answers. We had planned for a slightly longer Q&A session, but we couldn't manage to squeeze everything in this time frame. We've covered a lot of ground, but I would like to now hand over to Mr. Joachim Leite, Head of Climate Finance at the NDC Partnership Support Unit, to share some closing reflections and outline a path forward from today's discussion. Joachim, over to you.
Thank you very much, Prakash, and I would like to start by really thanking everyone, all the speakers, the panelists, the participants for your valuable contributions in time. And also a special thanks for the Adaptation Acceleration Hub serving as an umbrella for that, for UNDP to convening this. It's really a pleasure for us in the partnership and in the Center for Access to Climate Finance to be part of this exchange and to contribute to them. So I think today we have learned, I mean, we looked again into the sustainable the substantial adaptation finance gap that we have, and we all know the urgency that we have to close it in light of the increased climate change impacts that we have seen across the world and we see on a day-to-day basis. I think we also heard from our speakers from different countries and also from experts the importance that we have in linking climate and development. So countries have a lot of development challenges, a lot of pressing demands. So how to combine them and to look as climate as a part and parcel of development, but also as something that can push back and erase some of the sustainable development goals that countries have been fighting so hard to achieve. We also, I think, an important point that we are seeing and we're learning more and more, and that's great to see from someone who's been working in this space for more than 20 years, is like really seeing the ministries of finance coming closer and really owning this agenda that started a while back in the ministries of environment and the crucial role that the ministries of finance have that. And we've heard this inspiring operations from both Uruguay and also Rwanda, who are really leaders in this process. We also have been seeing more engagements of central banks, financial regulators, and the wider financial sector. And without them, we cannot deliver the practical solutions that other line ministries are really looking into and know where it needs to be done, especially on the more technical level. I think it was really great to see like all these innovative financial instruments that can address and kind of like reduce the very high cost that we have of capital, but also in addressing bankability for adaptation finance. We know this is a critical challenge. Adaptation is not as easy as mitigation when it comes to mobilizing finance, tapping into the private sector. So we need to be innovative and look into different sources of finance. So I think there also the importance of collaboration was very much highlighted. Very happy and like really pleased to be part of the efforts in the Adaptation Acceleration Hub that was really kind of designed to accelerate transition from planning to implementation, building on what is already there, which is very important, and working as catalysts and connectors. I think also very interesting to see the guidelines and the work that UNDP has been doing in this space with adaptation finance strategy guidelines, also the collaboration with Munich Insurance Re to work on the disaster risk financing and sustainable mobilization to integrate into climate finance strategies. And specifically on the presentations from countries, I really want to thank Uruguay and also a leader in this space with the experience on the sustainability linked bonds. And I think also very interesting to see the way they design the bond to also not only be penalized, but also to be rewarded when they overachieve. And I think that's something that is very important in the context of like many of the instruments and the strategies that are being put out there when it comes to climate and development. Also, I mean, Rwanda is always an inspiration. So thank you very much, Ms. Stella, for outlining the experience you have with the RSF. We know you're a pioneer in that. And we really see the importance of having this political commitment, as you outlined, having climate really integrated into the development strategy, the vision of the country. But also we see the importance of having strong national capacities and ownership to drive all these efforts. So thanks for outlining that. So a few words that I would like to say on behalf of the partnership. So the partnership is a coalition of countries, more than 140 countries and more than 100 international institutions. So we are very pleased and honored to have Rwanda was our co-chair until very recently. Uruguay has been in the partnership for many years. UNDP is one of the most important implementing partners within the partnership, and many other institutions that are engaged in this process. And what we've heard today resonates very strongly with what we see in the partnership. Climate finance is the most requested area of support. So just to give a sense, we have received requests from more than 100 countries, and those are being supported by more than 300 partners. And the vast majority of the requests are on climate finance, on how countries can tap into the resources to bridge the implementation gap, but also the ambition gap that we have to achieve to be able to drive climate action in line with development priorities. And in link to that, adaptation comes as a very strong priority for most of our countries. So the way we've been working under the leadership of our members, so we were created by countries to serve countries, is in two main ways. One is to support country-driven processes. So countries put forward their priorities, their requests, and we bring in this wide membership of 100 development and implementing partners, but that can reach to more than 300 partners to mobilize tailored in-country support, to strengthen governance coordination, to set up the foundations on the NDCs, on the national adaptation plans, the engagement of the ministries, the line ministries in terms of their particular work, to set policies, regulations, the studies, and also the enabling environments. And also since like the last 5 years, we have been working very strongly with the ministries of finance, central banks, and also public development banks to strengthen the capacities to really move finance to where it needs to be. One of the things that we've seen, and that's a very strong focus of the work based on what countries have been putting forward, is really on working on investment plans and finance strategies. And a lot of the resources that were shared today are very important to inform that work. And also in building the pipelines and financial instruments that can catalyze or use the very limited public finance that we have out there to drive private sector finance at scale. The other way in which we work, and that's very much linked to this effort today, and we are very eager to contribute and continue contributing to that, is on knowledge projects and exchanges. So we have a dedicated center, the Center for Access to Climate Finance, who was set up to help to distill and to learn practical experiences on the ground that countries are driving, especially highly vulnerable countries, so very much linked to the adaptation agenda, but also to identify what needs to be happening at the system level. So there are challenges at the system level. We know climate finance is fragmented, it's complex, it's difficult to access. So a lot of the experiences that countries are having on the ground, we are feeding into this high-level reforms and discussions so that they can be informing the discussions with very practical solutions. In that context, in the context of our work on knowledge, we have worked on the climate investment plan and mobilization framework together with the GCF and many of our members, and contributions from UNDP and our countries, and inspired by many of our countries, including Rwanda and their experiences. We have also worked on specific policy briefs, so recently on climate finance units, and also we are working on programmatic approaches to mobilize private sector at scale for adaptation finance. So moving forward, we are very, very much eager to contribute and to be part of these efforts, not only on the knowledge exchanges, on the convenings, on giving visibility to the knowledge products, but also for our member countries as they have specific needs and specific support areas where the partnership with this membership can support. We want to be there to also meet them where they are and mobilize the support in the way that is more conducive for them to advance their priorities. So with that, I would like to again thank you everyone for your participation, and we are looking forward to continuing this journey together with all of you. Thank you, and back to you, Prakash.
Thank you very much, Georgi.
Thank you so much. Thank you.
I think this is the